There is this wide divergence on the expectations when you're talking about the 10-year, and obviously that is what you're basing fundamentally everyone is when it comes to the yield differentials in place. But the point I want to make about that in terms of a question would be, if we were to see an environment where, say, for example, Goldman Sachs or whoever is right, and we have a 10-year around about that 4 mark, and it's not necessarily indicative of even further Fed tightening, because we've seen all of these emerging markets that have been hiking in lockstep with the Fed, are the conditions as such that they're going to continue to have to hike and then it'll shorten that differential? Or are you going to see a situation where, if we do get the Fed pause, is that what you're really gambling on, in a sense, in terms of your expectations, that will push down the 10-year to such an extent that it provides beneficial conditions for these emerging markets?
Okay, that's a great question. Look, our scenario reflects on the fact that this is a really rapid tightening that we've seen for the US economy. Monetary policy in the US is tightening to a level and at a pace that we really haven't seen in recent years. We have to look back to the 1990s or even the later part of the 1980s to see a rate tightening cycle at the pace and scale that we've witnessed this year for the US. And I think that sort of teases up to a situation where the most likely outcome now is a profits recession for the first half of 2023 and a GDP recession in the second half of 2023 in the US. Now, if we think about how that has played out with emerging markets, we've seen dollar strength all through 2022 for all the reasons that we just discussed versus many of the EM currencies. But actually, the remarkable development in emerging market FX is how resilient many of those crosses have been. It hasn't always felt like that. We've seen a lot of volatility on a number of EM crosses. But I think if you take a little bit of a step back, the preemptive tightening from many emerging market central banks ahead of developed markets responding to the inflation surge early has protected and insulated many of the emerging market currencies versus what could have happened in a more adverse scenario. So the way I look at it is actually emerging market asset classes have performed pretty resiliently, all things considered. Again, we have to step back and remember that the combination of Fed tightening, global liquidity being drained from the system, the food crisis, the energy crisis, the very difficult geopolitical situation, the legacy of the pandemic. This has been a terrible environment for many emerging markets when we think about the fundamentals. In asset class space, there's been some significant evidence of resilience. Currencies, fixed income, equities. So actually, in many respects, emerging market performance during the course of 2022 has been pretty impressive. We expect that's going to continue. We think emerging markets, particularly North Asia, are a really good area to focus on during the course of the next 6 to 12 months, that sort of 2023 strategy.